How to avoid psychological mistakes in trading. Welcome to this video on how to avoid psychological mistakes in trading. If you're serious about becoming a consistently profitable trader, I want you to listen very carefully because what you're about to hear may be more valuable than any trading strategy you've ever learned. Most traders fail not because their strategy is bad, not because the markets are rigged, but because of their psychology. They let emotions run their trading account: fear, greed, frustration, and overconfidence. Think about it. The market doesn't know who you are. It doesn't matter if you studied technical analysis for 10 years or just started last week. The only thing the market does is present opportunities, and it's your mind that decides how to react. Let me give you a quick example. Imagine a trader named Alex. Alex learns a simple moving average crossover strategy. It's tested. It works in the long run. But when the moment comes, Alex hesitates. He misses the entry, jumps in late, and takes a loss. Then, frustrated, he takes another random trade that wasn't in his plan and loses again. Was it the system's fault? No, it was psychology. This is why the legendary trader Mark Douglas once said, "Trading is 80% psychology and 20% mechanics." In this session, I'll break down the most dangerous psychological mistakes that destroy trading accounts, things like overtrading, fear of missing out, revenge trading, holding on to losers, ego, and overconfidence. And more importantly, I'll show you exactly how to avoid them with practical techniques you can apply right away. So if you've ever felt like the market is against you or that you're your own worst enemy, this next hour will change the way you look at trading forever. Let's dive in. The first major psychological mistake is overtrading. Overtrading happens when you take too many trades, usually because you feel pressure to make something happen. Instead of waiting for high-quality setups, you chase anything that moves. Here's a story. Imagine Sarah, who starts the day with a plan to take no more than 3 trades. But after losing her first trade, she feels the need to make her money back quickly. She takes another trade, then another, then another. By the end of the day, she has taken 12 trades, most of them outside her strategy, and her account is down badly. What caused this? Not the market. It was Sarah's emotions, her need to feel in control, her impatience, and her fear of missing out on opportunities. How do you avoid this? Set a daily trade limit. Decide before the market opens how many trades you will take. If you hit that limit, stop, no matter what. Keep a trading journal. Write down every trade and why you took it. When you review your journal, you'll see patterns of overtrading. Accept that missing trades is part of the game. The market will be here tomorrow and the next day. You don't need to catch every move. Professional traders know less is more. A few high-quality trades are far better than dozens of impulsive ones. Next, let's talk about fear of missing out, also known as FOMO. FOMO happens when you see the market moving without you and you panic, thinking, "I have to jump in now or I'll miss the opportunity." But often, that means you're buying the top or selling the bottom. For example, picture Tom. He watches Bitcoin spike up $500 in minutes. He didn't catch the move, but instead staying calm, he jumps in late, hoping it keeps going. The moment he enters, the market pulls back, and he takes a loss. How to fight FOMO? Remind yourself, the market never runs out of opportunities. There will always be another trade. Stick to your plan. If the trade didn't meet your criteria, it wasn't your trade. Simple as that. Use alerts. Let technology notify you when your setup appears, instead of chasing every candle. The best trades come to you. You don't chase them. You prepare and let them unfold. Let's look at revenge trading and holding losers. Revenge trading is one of the most dangerous habits. Revenge trading is when you take trades not because they fit your plan, but because you're angry at the market and want to win back your losses. Imagine David. He takes a loss in the morning. Instead of stepping back, he doubles his position size on the next trade, thinking, "I'll get it back right now." That second trade loses too, and now his account is in serious trouble. The solution? Have a daily loss limit. Decide the maximum amount you're willing to lose in one day. If you hit it, shut down your platform. See losses as business expenses. Just like a store pays rent, traders pay losses. They're part of the business, not a reason for revenge. Closely related is holding on to losing trades. Many traders can't cut their losses because they hope the market will turn back. They say, I'll just hold a little longer. But small losses can turn into account-ending disasters. The cure? Always use stop losses and never move them further away once you're in a trade. Ego, overconfidence, and lack of discipline. Another psychological trap is ego. Sometimes traders want to be right more than they want to be profitable. They ignore signals, refuse to admit mistakes, and keep adding to losing positions because their ego won't allow them to be wrong. Then there's overconfidence. After a few winning trades, some traders start believing they can't lose. They increase position sizes recklessly, take setups outside their plan, and soon give back everything they earned. The fix? Humility and discipline. Remind yourself that every trade is just one of many. Focus on long-term consistency, not being right every time. Celebrate discipline, not just profits. Did you follow your rules today? That's success, even if the trade lost. And how do you build mental resilience? How do you make sure you avoid these traps? Here are powerful tools. Pre-market routine. Start your day calm and focused. Review your rules. Do breathing exercises or meditation. Post-trade journaling. Write down not just what you traded, but how you felt. Over time, you'll see emotional patterns. Accept uncertainty. No one knows what the market will do next. Your job is not to predict, but to react with discipline. Think in probabilities. Any single trade doesn't matter. What matters is the outcome over hundreds of trades. Separate identity from results. A losing trade doesn't mean you're a failure. It's just a cost of doing business. To close, remember this. Trading is not a battle with the market, it's a battle with yourself. Master your emotions, and you'll master your trades. Thank you for staying with me through this session. If this helped you, be sure to like, subscribe, and share it with other traders who might be struggling with the psychological side of trading. And most importantly, trade safe, trade smart, and never stop improving.